Welcome back to Organization and Management. We are now in Chapter 2, which is about the firm and its environment. We're going to talk about the environmental forces and environmental scanning, the local and international business environment of the firm, phases of economic development, forms of business organizations. What do we expect in this lesson? Content standard. The learners have an understanding of the role of business in the environment and how the environment affects the firm. Performance standard. The learner shall be able to analyze the various environmental forces affecting the firm and summarize these using political, economic, social, and technological analyses or PEST, and strengths, weaknesses, opportunities, and threats or SWOT analysis frameworks. Learning competencies. The learners identify various forces, elements of the firm's environment, summarize these forces using the PEST and SWOT analyses, describe the local and international business environment of a firm, explain the role of business in relation to the economy, and discuss the different phases of economic development, and finally, differentiate the various forms of business organization. We're going to start with the basic one, which is forms of business organizations. There are three basic forms of business organizations, and the first one is sole proprietorship, partnership, and corporation. Sole proprietorship is the easiest form of business organization to form. It is the most convenient to operate, and it's also the easiest to liquidate. Now, this is the reason why most small businesses are in the form of sole proprietorship, such as salons, sari-sari stores, and even internet cafes. The second one is partnership. It is a voluntary association of two or more persons. And this is also a type of business organization that is easy to form. When you say a professional partnership, two or more people in the same profession come together and form a business. So it's a pool of talents and expertise. The partners in this type of business complement each other, and they are also guided by the code of ethics. They are responsible to their clients individually and collectively. There are different types of partnerships according to type of business operations. So it can be marketing or trading, manufacturing, or service. In marketing or trading, the business is engaged in buying goods and selling the same without making any physical change on the product. And then in the manufacturing business, the business would purchase raw materials and convert it into finished products before selling them. Now, for service partnership, it involves the rendering of professional and non-professional services. Now, the partners may be classified as to their liability for partnership debts. So there are three different types of partners: general partner, limited partner, and a general limited partner. A general partner is limited or liable for partnership debts to the extent of his personal property after all the assets of the company has been exhausted. Say, for example, upon liquidation, the assets of the business are not enough to pay for the debts, then the personal property of a partner may be used to pay for the debt. Now, a limited partner is only liable up to the extent of his investment. So even if there are still debts to pay, business debts to pay, he doesn't need to use his personal property to pay for those debts. They can use only what he invested in the company. Now, a general limited partner has all the rights, the powers, and subject to all the restrictions of a general partner, but is liable only up to the extent of his investment. Partners may be also classified as to their contribution. So we have capitalist partner, industrial partner, and capitalist industrial partner. A capitalist partner is the one who invests money or property to the business or the partnership. And an industrial partner is the one who invests his work, labor, or industry to the partnership. And finally, a capitalist industrial partner is the one who contributes both money or property and also his work or industry to the partnership. Now we're moving on to the third form of business organization, which is corporation. The formation of a corporation requires a lot of work. And the one who undertakes to form a corporation or cause it to be formed for a specified purpose or purposes is called a promoter. A promoter's job includes contracting people, opening bank accounts, and all other things that are related to organizing or starting the corporation. Now, all the costs incurred in the formation of a corporation are called organizational costs or organization costs. Now let us summarize the three forms of business organization: the sole proprietorship, partnership, and corporation based on these categories: ownership, capitalization, life or term of existence, management structure, profit distribution, income taxation, and liability to a third party. For a sole proprietorship, again, it only has one owner. And for capitalization, it depends on the needs of the business. Some businesses would require only low capital, let's say for a sari-sari store. But if you want to open up a salon, it might require you more capital for you to be able to buy the equipment needed in a salon. Or if it is an internet cafe, you need a higher capital also compared to a sari-sari store because you will have to buy several sets of computers. Now, the life or term of existence of a sole proprietorship is dependent on the owner. Since there's only one owner, he or she can decide whether he wants to stop doing the business or continue doing the business. So it is dependent on the owner. The management structure, it is managed by the sole proprietor. Just like what is mentioned in the early part of this video, most small businesses choose to be in sole proprietorship form, and whoever owns the business also manages the business. In profit distribution, of course, all profit goes to the sole owner. There's no other people he needs to share it with since there's only one owner. And for income taxation, the sole proprietorship pays individual income tax. And there is unlimited liability of sole proprietor. If the business or if the owner decides to stop doing the business and there are still standing loans or debts to suppliers or creditors, then he has to exhaust all the assets of the business first. And if the assets are not enough to pay for those debts or loans, then he has to use his personal property to pay for those debts or loans. Now, for a partnership, it is owned by two or more people. And the capitalization also depends on the business. If they want to start just a small trading partnership or business, then it might require lesser capitalization. Or if they want to, let's say, open a professional partnership, say for example for dental services, then they might have to invest more to buy those expensive equipment used in a dental clinic. And the life or term of existence of the business is dependent on the partners. Its term of existence may be any period of time stipulated by the partners. Now, the management structure of a partnership, it is managed by one or more partners. So they can decide whether there's a managing partner or all of them will be part of the management. And then the profit are based on the agreement or based on law. Basically, if there is an agreement, let's say there are like four partners in the business, and then they decide to divide the profit equally, then the income will, each of them will receive 25% of the income for a certain period. So that is based on their agreement. Now, in terms of income taxation, a partner pays individual income tax on his share of partnership profits. So each partner would pay his or her own individual income tax. As to the liability to a third party, just like what was mentioned in the earlier part of the video, there are different types of partners in terms of liability. So a general partner would have unlimited liability, and then a limited partner would have limited liability. Moving on with the next one, corporation. For ownership, it is owned by 5 or more owners. And the capitalization would depend on the type of business, different type of businesses. The law requires different capitalization for different type of business. And its life or term of existence is 50 years and can be renewed after that period. It is managed by the board of directors, and the stockholders receive the share in the profit based on the dividend declared by the board of directors. The corporate income tax is paid by the business itself, and then stockholders pay based on the dividends that they received. And then in terms of liability, there's limited liability of stockholders, so they are liable only to the extent of their investment in the business. In summary, for a sole proprietorship, the advantages would be it is easy to form and there is less government requirement. There is fast decision making since there's only one person making the decision in the business. There's flexibility of operations because it depends on what the sole proprietor wants. It is also suited to small businesses. Now, for the disadvantages, there is limited source of capital. It's only the sole proprietor who would produce or get the capital that can be used for the business. And the life may be dependent on the life of the owner. That means, sadly, if the owner dies, then the business also ceases to operate. The management that may be dependent on the capacity of the owner. So if there isn't enough skills, then the owner might have a hard time running the business. Now, for a partnership, the good things about it would be it is easy to form and it is subject to less government requirements. It is suited to the practice of profession, and some are exempted from income tax, and also there is flexibility of operation. Now, the disadvantages, there's unlimited liability of the partner for the debts of the partnership if you are a general partner. There is limited term of existence. It depends only on what was stipulated by the agreement in the partnership. And there's limited capital, and which is different from what the corporation has. For a corporation, good things about it would be there's capacity as a legal entity. It is a separate entity from the owners. There's practically unlimited life, although there's like 50 years stipulated by the law. It can be renewed. And there's limited liability of stockholders for corporate debt, so they don't have to be liable to the extent of their personal property. And there is wider source of capital. If they need more capitalization, then they can issue more stocks to get capital. The disadvantages would be activities are limited by the articles of incorporation and corporate bylaws. They always have to adhere with what is written in the articles of incorporation. There is possibility of abuse of powers of officers, and it is subject to more governmental requirements.